International investing.
Mm-hmm.
I know it sounds flashy. It is a very cool thing to say and do, but purely from a investment logic, from a
Mm-hmm.
financial prudence standpoint,
Mm-hmm.
investment prudence standpoint,
Mm-hmm.
why should you do it?
See, typically our portfolios have home bias. Okay, they are biased
Right.
towards the home market.
Yeah.
Okay, you understand those companies, you see those brands, you use their products.
Mm.
Okay, you live here. Most importantly,
Yeah.
okay, you buy assets there. You're planning to spend your life in India.
Right.
So your portfolio should be concentrated in India only, on India
Yeah.
India story only.
Right.
Okay.
Mm.
If inflation is high, it will impact your living standard. Inflation, there is a recession, it will impact your living standard.
Right.
Okay. So a portfolio should reflect that reality.
Mm.
Okay.
Mm.
But it is also true that a portfolio that is concentrated on local market expose you to economic and geopolitical risk associated with that particular market. Okay, let me give you one example.
Yeah.
Like in 2004 elections, okay, NDA lost the election, 2004 general elections,
Right.
unexpectedly.
Okay.
Okay, so entire market was rooting for comeback of NDA
Right.
government in the power. Okay, so there were two lower circuits after the next day after the result. Okay, and Nifty was pulled into bear market.
Okay.
Okay. And that bear market, Nifty recovered after 6 months from that bear market and made a new high. So elections were in May and new high was made in around October near Diwali.
Okay.
Okay. So it was a India-centric bear market. It had to do with political risk associated with India.
Yeah.
Okay.
Right.
Associated with India. During the same time, S&P provided nearly 10% returns, S&P 500. So if you have some diversification toward S&P during that time, you could have protected yourself against some losses.
Right.
Okay.
Right.
So that's the home market bias introduce a political and currency risk. Okay, that can be diversified through international exposure. So if you have to name a single biggest factor in a particular economy or a particular country, for a particular country, it's its currency.
Yes.
Okay. So there is a significant currency risk that is associated with investments in financial market.
Okay.
Okay. International exposure give you opportunity to diversify that particular currency risk.
Right.
Okay. Like India was one of the worst performing currency during from 2001 to 13. Okay. There was a depreciation of nearly 50% at that time. Okay. The market returns were quite stagnant. There was nearly 20% losses during that period. Okay. And but if you look at the S&P 500 during the same phase, okay, from 2000, let's say 2010 end to 13 end, okay, there were losses of around 20% that time. But in S&P 500, if you see, there were gains of 50%. Okay. Wow. But if you add currency depreciation angle, okay, those gains would become 100%.
Okay.
So that's how geographical diversification can help you, okay, mitigate the risk, macroeconomic risk associated with Indian market. So when you are investing, in international markets, okay, in general, yes, there's a diversification away from the local markets. Okay, it's a currency diversification is there. Even the correlations are quite low. Different markets are in different economic cycles.
Right.
Okay?
Right.
But it comes with significant political risk. Okay. Political and macroeconomic risk. You have to understand one thing. In this market, in India, where you are sitting, you are getting a constant feedback.
Yes.
Okay. You know which companies are doing well. You know which companies are not doing well. Which brands are successful in the market. If you go to a market, you can see which brands are there, more starting to get more visibility on the shelf.
Right.
Okay.
Right.
Where your friends are buying cars, which cars are getting more popular, which segments are doing well. There's a constant feedback mechanism.
Right.
Okay.
Right.
That is missing when you're investing in foreign markets.
Yes.
Okay. And from that information asymmetry comes the risk.
But that is where these international, like you said, the emerging market ETFs and other foreign market ETFs, that's where they come into play, right? Because they give you this sense of what is the right thing and they adjust accordingly to give you that return. Wouldn't that be right?
See, thing is that I would say that the diversification, a geographical diversification is an opportunity, okay, which should be availed by everyone, okay, investors out there, okay. But when you are availing that opportunity, the view should be long term.
Right. Correct.
Okay. Right now, China has given the stimulus. Okay. Hang Seng has gone up by around 20%. And I've seen on some groups, people are searching out, okay, is there Hang Seng ETF available? Where we can take exposure. Nobody was ready to touch China with a barge pole for last 2 years. Okay, suddenly a stimulus as announced in last 15 days, they frenzy about how to get exposure to Chinese market that is doing well. So if you see China doing really well over the next 15-20 years, okay, you can take the exposure.
Yeah.
Okay, that's there. You can take the exposure. But in general, it should be a long-term view.
Right.
I typically recommend people to go for Nasdaq 100 ETFs, which are out there. Okay, there are some options which are out there in Nasdaq 100. Nasdaq 100 ETF, I asked for that because it's a different exposure. Okay, your tech innovation angle is missing in Indian market. Okay. Tech innovation angle is missing in Indian market. We are still basically at 3,000 GDP per capita.
Yeah.
We will reach, when we cross 10-12,000 GDP, our GDP per capita reach that level, then the technology innovation, R&D,
Will kick
those
start.
allocations will start increase. They will kickstart. Okay. But as of now, we are more of a main place of manufacturing and services.
Right.
Okay.
Right.
Those are the place. But if I want to get a slice of global R&D, global innovation, so I can take that exposure through Nasdaq 100. So it's a very different exposure.
Right.
It's an extremely different exposure that is missing from the Indian market. And if you see historically, correlation between the Indian market and Nasdaq is also quite low.
Right.
It's around 0.2%. And they've also moved in different directions. So that makes it a perfect hedge.
Perfect hedge.
Because in 2000 to 2010, Nasdaq has given nearly minus 20% returns. Nifty 50 gave around 600%. Okay. In next decade.
Right.
Okay. In next decade, if you see, just in dollar terms, if you talk in the dollar terms, okay, there's a 5 times value appreciation, nearly 500% returns in price appreciation only from Nasdaq. Okay. Another 100% was there from currency depreciation of INR. That makes it 6 to 7x. Okay, in Nasdaq. In Indian market, returns were hardly 100%. Okay, because it started pretty bad from 10 to 14. So they complement each other. Okay, but if you tell me, okay, we want to invest in Indonesia, okay, we want to invest in South Africa,
right,
okay, they're pretty similar markets.
Right.
They're pretty similar markets with lower growth prospects, a relatively weaker currency that has depreciated significantly in last few years. Indonesia has not depreciated, but it's a quite similar market. There's no differentiation in exposure as such.
You might as well concentrate it in your home market, which is similar to that, where you have much better understanding.
You have much better understanding. Risk for you is less, relatively less. If we are investing in Indonesia or let's say South Africa or in Brazil, risk is extremely high. Okay,
right.
And returns, or you are looking for diversification benefit or returns or some sort of a hedge, that is missing.
Right.
Okay.
Right.
So you have to be really careful when you are taking international exposure.
So if I can summarize this and again point if there are any mistakes here, international diversification definitely makes sense. But what is important to always consider is you are diversifying into a market which is very unlike yours. That is point number one. And point number two, you are doing it in a manner to not just hedge against your country's geopolitical currency, those kind of risk, but if in the case of US, you pointed out that you are getting a slice of a certain sector which is not available
which is
here.
Missing. That's more important.
That is more important.
Yeah.
So what is the right allocation to have between these?
See, typically your allocation should be 10% international allocation.
Okay.
I know there is a lot of literature around the home market bias, and people say that the portfolio should be distributed across, representing the geographical, basically global composition of the stock market in general. I disagree with it.
Okay.
Humbly, I disagree with it. Okay. Thing is that you are living in India.
Mm.
Okay.
Mm.
Your income, you are working in India. Your income, what is your take home salary? Okay, what are you spending on the grocery? Which car are you buying? They are all dictated by macroeconomic trends in India.
Right.
Okay.
Yeah.
Basically, if there is, let's say, market crash, yes, your savings would go down. Okay, your income would go down, but then price of commodities would also go down.
Things will also go down.
Okay.
Yeah.
So basically, your life is aligned.
Yeah.
Your life is aligned with the macroeconomic realities of your home market, where you're going to live, where you're going to spend your life.
So you're not disproportionately impacted.
Yes.
Yes. Okay.
You're moving with the trend.
Okay.
Moving with the trend.
Right.
So 90% allocation should always be in your home market. Okay. 10% you can go for international exposure. That's more of a hedging. Hedging against basically hedging against adverse developments in your home market.
And plus, like you said, to get a slice that is missing.
That can also be done.
Yeah.
You can look at with that perspective as well, that you are looking for some exposure which is missing in your home market.
Right.
Okay. There are some people who have dreams of sending people, their kids for higher education to US.
Yeah.
Okay, for colleges. They can also make some estimations around it. Okay, that what would be the amount that would be needed. Okay, at that time, let's say kid turns 17, you're sending for graduation after SAT. Okay, so what is the amount that would be needed? Okay, when kid is going for masters, you want to prepare for basically provide financial help for their masters as well.
Yeah.
Okay, so what would be the actual outlay that would be needed, and accordingly that allocation can also be done towards US, because now, as your expenditure is going to be in US,
yes,
okay, it would be defined by economic realities of US.
Exactly. Right.
Okay.
Right.
So if you take the US exposure equivalent to that spend, okay, that will hedge you against the currency risk or any macroeconomic risk that is associated with India.
What are some of the other exposures that one could look at?
See, first of all, the investments, if possible, investments should be made on the instruments which are listed in local market.
Right. Okay.
That makes things very simple, straightforward. Okay. That saves a lot of
like
headache.
the NASDAQ ETF.
NASDAQ ETF, Hang Seng ETF, which is out there. There's a product on S&P. There's a Mirai has a line of thematic products. Okay. These are available in FOF format. Okay. On thematic ETFs which are launched in US. Apart from that, you should go for US market. Okay. Look at the instruments which are listed in US market.
Okay.
US market provide a pretty wide range of global instruments, exposure to them. Okay. There are nearly 60 single country ETFs which are out there.
Oh, okay.
So apart from these two markets, you should not go beyond. You should not think about investing in any instruments that beyond these two markets. Okay,
which is India and the US.
India and the US.
Right.
Now let's talk about where one should invest. So there are different themes that can be looked into. Okay. So one is the innovation slice, which is there.
Okay.
Commodity slice is almost missing from India. Let's say you want to take exposure to oil exporting nations.
Yes.
Okay. Or commodity majors.
Yeah.
As you want to go for Brazil, Chile, Russia. You want to take exposure to these kind of countries. Basically, you feel that commodity inflation is typically negative for India, so you want to hedge your bets by making some small exposure there.
Right.
Okay. Ideally, is single country exposure should never be taken.
Okay.
It should be avoided, like China or even Germany or Japan. Because they come with a lot of risk. Japan is a very mature economy. It's a much larger economy than us, and it can be considered safer.
Yeah.
Okay. So now people have been talking about the Japan index that is given nearly 100% returns in last 3 years. It went from 20,000 to nearly 40,000. But if you see, Japanese yen has depreciated by nearly 30% against INR during the same period.
So it kind of eats into
the return. So these are the risks which you are not aware of. Okay, when you are investing in single country ETF.
Right.
So when you are investing for US is a different US is a different market altogether. If you are taking a US exposure, it's a different thing. But outside the US, when you are look for themes. different themes which are there. Some themes are robotics. Okay. Robotics is one of the theme. AI is one of the theme. Okay. Where the main players are distributed across different continents.
Yeah.
Okay. Commodity is one theme. Okay. But they should be multi-country products. Okay.
Right.
So when you are taking exposure, international exposure, it doesn't mean that expose yourself to the political risk or macroeconomic risk
of one particular country.
Of one particular country.
Yeah.
Okay.
Yeah. Okay.
It should be risk should be geographically diversified.
Right. So another way to look at it is that when you are looking at an investing opportunity outside of India, more than looking at a particular country, you're looking at opportunities that do not exist in India.
Yes.
But tax, when you look at tax as an angle for international in this, tax in India is complicated enough. Now you're talking about international taxation. How should one prepare for that?
One thing you need to understand that you have to pay tax. Either you will pay in your home market or in foreign market. Okay. Tax is unavoidable. Tax has to be paid.
Yes.
Okay. So typically investments in foreign markets are governed by double taxation avoidance arrangements. Okay, which are there. So there are two ways DTAs typically help in taxation. So one is full waiver. Okay. If you are paying, let's say in US, you need not pay tax in India, or you are paying in India, you need not pay in US. Okay. Second is you get the tax credits for the tax that you have paid in foreign market.
Right.
Okay.
In the form of?
Basically, let's say in US market, there is a 20% withholding tax. The 20% profits would be kept by submitted to US authorities in form of tax. Okay. Right. So in India, let's say tax is 25%. Let's say for a minute, the tax is 25%. So you need to pay only 5% tax on gains. Okay, because 20% is tax credit.
So it's adjusted against.
It's adjusted against the payment. If you are investing through, let's say India listed instruments. Okay, India listed instruments, they are governed by Indian taxation laws straight away. Okay, so taxation is typically for if you are holding investment less than 2 years. Okay, so capital gain taxation would be as per your slab rate. And if it is more than 2 years, it would be 12.5%. Gains will be taxed at 12.5%.
Got it.
Okay. Any dividends, any interest that you receive would be taxed as per your tax slab.
Okay. And from a making a choice point of view, from a benefit to the investor point of view, what would be a right thing to do?
To reduce the paperwork, I would suggest that go through, if possible, go through instruments which are available in India.
Right.
Okay. But if you still want to go outside, go to US market. In US market on capital gains, there is zero withholding tax.
Right.
Okay. So you are subject to similar taxation that is there on foreign investments through mutual fund and ETF route. Okay. So investing, let's say, but you are buying an Apple share and you make some gains. There is zero withholding tax in US.
Oh.
Okay.
Okay.
Any instrument that is listed in US, there is zero withholding tax, and you have to pay in India only. But it needs some additional paperwork. Your paperwork increase significantly due to foreign investments. I would say pay taxes in India because US taxation is way higher than Indian taxation. You're paying taxes around 25% or 40% there. Here the taxation is quite low. Okay. So you're paying at 12.5% after 2 years. So there is zero withholding tax there.
Right.
Okay. If you are investing as an Indian. Indian citizen. Okay. On dividends and interest, there is 30% withholding tax. Okay.
Right.
You will get a tax credit for that. And if your tax slab is less, let's say your tax slab, you are in 20% tax slab, you can get a tax credit here.
Got it.